I've got a wonderful panel tonight with real industry leaders. I'm going to ask a few questions. We've got some discussion going, but please, I would urge you to come forward with questions, put your hand up. I shall offer questions open to the floor at some stage. And I'm sure you must have some burning questions for three leaders in our industry. So let me introduce our panel tonight. As I said, it's a very high-powered panel. From my far right, we have Sean Boyd, who's the Vice Chairman and Chief Executive of Agnico Eagle. You know Sean, he's been speaking here for many, many years, and I know travels through Zurich a lot. He's actually a chartered accountant. In fact, we have a chartered accountant, a chemical engineer, and a lawyer, I think, here tonight. So I'll represent the mining industry. Sean is a chartered accountant. He's been with Agnico since 1985 and took over the reins as chief executive in 1998, I think. And through his tenure, he's overseen the growth of Agnico from a company with a single mine purely in Quebec to now one of the world leaders with 8 operations, mainly in Mexico and in Canada, but of course in Europe, in Finland as well. In 2015, they produced a record almost 1.7 million ounces of gold plus over 4 million ounces of silver. And the company's valued at about $9 billion US at the moment. And then we have our chemical engineer, George Paspalas, is president and chief executive of MAG Silver. George joined MAG in 2014. He was formerly the president and chief executive officer of Horizon Mines and worked in senior positions for Silver Standard Resources and Placidone. As I said, he's a chemical engineer, and I was going to say he's Australian, but he just told me he was granted Canadian citizenship last week. Congratulations.
Cost me a lot of money with that.
Now, MAG Silver has part ownership of one of the highest grade and largest silver deposits in the world. It's in Mexico. They have a 44% interest in a joint venture with the world's leading silver miner, Fresnillo. And he will tell you, no doubt, a bit more about the Junicipio joint venture a bit later. The company is now valued at 1.2 billion Canadian dollars. And last but not least here, Peter Marrone. Peter's our lawyer on the panel. Peter is chairman and chief executive of Yamana Gold. He founded Yamana Gold in 2003. And prior to that, he was head of investment banking at a major Canadian investment bank, and before that, practiced law in Toronto. Yamana's cornerstone mines are Chapada in Brazil, El Peñón in Chile, and they also are in joint venture with Agnico Eagle at the Canadian Malartic mine in Quebec. In 2015, Yamana produced 1.28 million ounces of gold, 9 million ounces of silver, and 131 million pounds of copper. And the company is now valued at about 5.3 billion Canadian dollars. We have about 45 minutes. You'll be eating while we're talking, as I said. I'm going to ask each of the panelists to just give us 5 minutes on what they've done in the last year. I know Sean was here last year. The other two weren't, but for those of you who were here last year, I'll ask them each to give us 5 minutes on what they've done in the last year, and then we'll start to tackle some of the questions in this fascinating industry with the dynamics and the volatility we've seen in the last few months. We'll ask, hopefully, some of the important questions that you as investors feel like asking. So, Sean, if I could start with you, just give us a 5-minute rundown on how Agnico has developed in the last year.
Thank you, Paul, and thank you, Paul, once again for doing this. We really appreciate you being the MC of this for the last couple of years, and thanks again. As far as Agnico goes, last year was really a continuation of 3 or 4 years prior to that, where we were really focused on the continuation of moving some of our key assets forward, as well as we took an interesting approach on exploration where we doubled our exploration budget in a difficult gold price environment. And we did it largely because of the opportunity set we saw to add high-quality ounces, because our focus is really sort of what does the company look like 5 years from now. And we can see a growth in output from assets we currently own in the order of 30 to 40%. So our expectation 5 years from now, we're producing over 2 million ounces of gold, high-quality ounces. A lot of those ounces are really going to be driven off of improving grades from our pipeline and taking advantage of additional processing capacity that exists at our current producing assets. So it was one of continuing that building approach, but the focus was really also to improve the financial flexibility, because even though we did increase our exploration spend, we were still, and move significant projects forward, we were still able to reduce our net debt position by $200 million. And the reason we were able to do that, as Paul had mentioned in the introduction, we were producing record amounts of gold at improving costs. So our margin was expanding in a difficult environment. So that's what we've been up to since I was here last year to update you.
George. Thank you. And can you hear me? Right. I hope you can understand my...
We can hear you, we can't understand.
Yeah, I hope you can understand my newly acquired Canadian accent. I'm trying to adjust to it myself. Paul introduced MAG as one of the highest grade silver deposits in the world. He's actually wrong. It is the highest grade undeveloped silver property in the world. It's a testimony to almost a culture we have in the company. Also with me in Zurich is Dr. Peter McGaw up the back. I think a lot of you in Zurich know Peter well. From 2003 and the IPO of MAG, we've been focused on trying to work, discover and then develop not just high-grade assets, high IRR assets, assets that have the potential to have a district scale in terms of their size. And that has bode very well for us as we sit here and say, yeah, we have the highest grade undeveloped silver property in the world. We also have 6 other high-grade discoveries in the company. And if you look at our performance, our share price performance over the last 2 years, our shareholders are very happy with our performance because we stayed flat or we stayed slightly up. And that's the rationale for our strategy. We look for assets that will withstand anything that metal prices can deliver. And I think the challenge for us now is, I think we've come through the recent, call it bear market. Everyone loved MAG because it's a great defensive stock. But as metal prices start to rise, we need to ensure that you out there understand we also have a lot of value creation within our company, and we're not just a defensive stock. Last year, we put 4 holes underneath that highest grade undeveloped silver property in the world, and we were quite astounded with what we found. We found a mineralised zone down there. This has expanded significantly from what we have, up to 5 times in width, significantly high grades, and we're following up that drilling now. So in probably late May, early June, we're going to release the next round of results from that drilling program. And it's timed well with our partner Fresnillo, world's largest primary silver producer, who is also the operator of the asset, right in their front yard, right where they've built 3 similar mines over the last 3 years. So MAG represents a company that has a great asset on paper, being executed, brought into production by probably the best people on the planet, and we're pretty excited about what we may have found underneath that. And where the value really comes in this is, for Fresnillo, the operator, their profit centre has changed from an old historical mine called the Fresnillo mine to a mine now that's on the same vein as ours. So our asset was a bit of a pariah historically in the world of Fresnillo. It's now their new best friend. And that's why we've had such good share price traction this year. We became fully funded in February. We funded at $10. I know some people in the room contributed to that. Thank you very much. And I think you enjoy that you're now 60% up on that in 6 weeks. And that's testimony to where this share price and this asset can go to. I think that might have been more than 5 minutes, but
You
you
were
saw
asked
it.
You were asked to stretch because my microphone was
oh, there you go.
So we're now operational again. Peter, over to you. Yamana Gold.
Teamwork, man.
well done. They changed my microphone. They tell me because it wasn't working. I think it's the reason for that is because I'm losing my voice. And so they needed to give me a more powerful microphone. Yes, I'm a lawyer by training. And as one of our shareholders, a longtime shareholder in this city, recently said, invested since 2003. So great return on that investment. But they said that a mining executive, a mining founder, is really a mining promoter. And a mining promoter, if you look at it from that point of view, I've gone from the dark side as a lawyer to the darker side as an investment banker to the darkest side as a mining promoter. In the course of discussing what 2015 meant for Yamana Gold, I think it's important to say what this company has endeavored to do, not always successfully, but mostly successfully, since 2003 when it was founded. We looked at it from the point of view of high-quality assets, perhaps misunderstood assets, assets that could deliver better value than what was in people's perceptions of things, in high-quality jurisdictions. We are an Americas-focused company that operates out of 5 of the best jurisdictions for mining in the world, in North and South America. One of our more high-quality mines, one of our cornerstones, is a mine that we operate jointly with Agnico Eagle. And it's been a great relationship since we bought that asset through the purchase of Osisko in 2014. In 2015, we looked at the 10 mines that are in operation in this company, at that roughly 1.3 million ounces of production, Paul, that you mentioned. And we endeavored to do the following things, particularly in the context of a low gold price environment. We said, how do we optimize what we have? How do we improve the quality of management? How do we decrease our G&A in the context of improving and streamlining that quality of management, while still delivering roughly 1.3 million ounces of production on the gold side, 9 million ounces of silver, and 130 million pounds of copper? Some might have said it's a very difficult task. Why are you undertaking to do all of that? And the reason we did is because our conclusion was that by taking these steps in 2015 to become more efficient, to manage our business better, to improve our balance sheet, we reduced our debt and improved our working capital by a full $350 million last year. We would be better positioned for that next wave of growth in the company and better positioned for a positive movement in the metal prices. So I'm very happy to say that we executed on all of that. And while it is not so apparent on the management paradigm shift that has occurred in that year that has made us more efficient, with me saying it to you, perhaps it's apparent in the numbers. We've taken our G&A, the cash portion of our G&A, from $123 million to this year's $85 million. And that's a pretty significant feat, I would say, in the course of a year to a year and a half. We've improved our mine plans, and similar to what was said by Sean, we were perhaps distinguishing ourselves. We didn't double our exploration budget, but we increased our exploration budget last year, and we increased it again this year. And interestingly, we've increased it this year above what we guided would be the amount to be spent for exploration at the beginning of this year. And the reason for that is because we're seeing some spectacular new discoveries, and the focus of this company, strategically, what we've tried to do is to focus on new discoveries at existing mines, because it is easier to bring that ounce of new discovery to production and to cash flow than an entirely new deposit that then has to be built with risk to capital and the risk to the development timeline. So in summary, Yamana Gold in 2015, we called it a transition year. It was an important transition year, recognizing what had happened in the metals market. We were taking advantage of compression to costs. We succeeded at that. Improvement to mine plans, we succeeded in that. And now that positions us for 2016 and the years to follow, with a production this year of over 1.3 million ounces, increasing to close to 1.5 million ounces in the next couple of years. But that doesn't tell the entire picture. because part of the philosophy of this company since 2003 has been to properly balance production and costs, so that we want to be one of the lowest, if not the lowest cost producer. I'm delighted to hear the highest grade operation, or the highest grade undeveloped deposit, or the highest grade developed deposit. But we want to be the lowest cost producer in the industry as well. And if we don't succeed at being the lowest cost, we certainly want to be within the bottom decile. That production growth that you'll see in this company in the next couple of years, that we began to develop and to nurture in 2015, will be at that low cost and indeed at a lower cost. In 2018, we have a new mine that will start operation in the country of Argentina. What a great country today to be operating in. That is one of the richest gold and silver deposits in the world, with a production platform of 5 million ounces of silver, increasing our silver production to over 12 million ounces annualized, increasing our gold production in 2018 to close to 1.5 million ounces, a production platform of 150,000 ounces, Paul, 5 million ounces of silver, at an all-in cost, including sustaining capital, operating costs, and G&A, of below $600 per ounce.
Now, you talked about you've been talking about the future, and you talked about cost. You want to be the lowest cost producer in the world. Costs are obviously important to margins in an environment we've seen the last 5 or 6 years. Cash costs have come down to the lowest for about 5 years, according to GFMS or Metals Focus. There's obviously been cuts in G&A, as you mentioned. You've tightened up your offices and all the administration costs. You've been helped by diesel costs. There's been exploration drilling is cheaper and things like that. But can I ask each of you, is this trend to lower costs sustainable now? Can you keep lowering costs, or basically is all the fat being cut out of the equation now? And let me take it back in reverse, as you were talking about costs. Would you like to kick off, Peter, on this one?
It's always difficult to say, and in part the reason for that is because our US dollar denominated costs will be impacted by local currencies. We look at our costs from the point of view of what it costs in the local currency, and is there an improvement there, and then how does that translate into US dollars. We're heavily reliant on local currencies in most of our operations, between roughly 70 to 75%, depending on the mine, all the way up to 85% in some of our mines, is locally denominated costs. So clearly it's difficult for me to say if the trend of reducing costs will continue, because the impact to costs of what happens with the US dollar exchange rate to local currencies will have an impact on that. However, what I can say to you is that I don't think that all the fat has been taken off. I think that there's more opportunity for it. And I would say to you that more than just the cutting of costs, it's the creation of efficiencies, the improvements and optimizations, that I think there's still more to come, certainly in our operations. On the South American side, and I think this distinguishes itself from North America, on the South American side, there's an excellent opportunity that will take some time to realize, but it is a good opportunity, which is more automation. Emerging market countries are less automated than developed countries. We see this, for example, at our Chapada mine, which is automated, but not to the level of Canadian Malartic. The two assets have about the same throughput of about 53 to 55,000 tons per day. So they're very comparable operations, but we rely on more people at Chapada than we do at Canadian Malartic. And in part, the reason for that is because of optimization. These countries in which we operate are very sophisticated, intelligent, well-educated countries. They recognize the importance of under-reliance on labor and more reliance on automation. I think that's what represents an excellent opportunity for us.
Okay.
May I say also, in addition to that, I think the other opportunity for improvement that we have not seen yet, certainly in our company, is we've gone from a period where we have been self-reliant on development, waste removal, to relying on contractors. We're now at a point where we have some reliance on contractors. I think that we can drive better bargains with those contractors because the extractive industries are in a downturn.
I'll come back to a couple of those points, but first I want to ask George, in your project planning now, are you looking at much lower operating costs in your projections for silver?
Well, we are. We're not the operator. Fresnillo is the operator, and they're very good operators. They're very cost conscious. The biggest beneficial effect we've seen at the moment on operating costs is local currency devaluation. But in a previous life, I'm an operator, and I used to run mines in the mid-late 90s when gold was $270 an ounce. And I think what's happened here in the last, say, year and a half is a lot of that easy, low-hanging fruit has been picked. You can cut exploration. I mean, that's a short-term focus, but you can cut that to pretty up the numbers. You defer expenditure. You get rid of all your surplus people and the decisions you made on the ramp up in the price. But I like what Peter said. I mean, the next stage in cost reduction and for the industry to go to the next level, you may have to spend money to bring your costs down and bring in efficiency improvements. And that becomes a difficult management decision when you've laid people off and things are tough and there's no more free coffee or biscuits in the office. We're now going to go and spend some money to actually save some money, and it takes conviction. And but I think that's the next step now. I think there's incremental improvements to be made in cost cutting, but we now have to look for productivity improvements and efficiency improvements.
I think you're very right there. Sean?
Yeah, we don't see any significant decreases ahead for the major inputs. We don't see us paying our employees less. We don't see any significant decline in the oil price from here. The key driver for unit cost is grade. And we've just found ourselves in a position over the last 4 years where we've been sequentially increasing production to record levels, and our unit costs have come down. And we've actually mined 22% below our reserve grade for the last 5 years. So part of the growth that we're talking about going forward is taking advantage of a mining sequence that is actually going to allow us access to better grades. So from our perspective, we're focused not only on increasing the production, but we're in a very strong position to manage unit costs going forward. And, we always sort of sit here and we're almost as an industry on the defensive because as an industry we have made some mistakes. But I would rather look at it now from the perspective as the gold price is turning and say, what is the opportunity? And part of the opportunity is that a lot of businesses have squeezed out costs. A lot of businesses have recast reserves to the point that they're more realistic in terms of gold price assumptions. And that puts the industry in a position going forward to actually deliver the margin expansion. And Peter and I were at a dinner last night and we were talking about the opportunity. And the opportunity around the improvements of the business or the optimization is that in a rising gold price environment, some people look at the stocks and say, oh my goodness, we've missed it because the stocks have run in the last 3 months. No, you haven't missed it because we think gold is going to go up, and a $1,500 gold price makes a massive difference to the vast majority of this industry, particularly after the industry's gone through a process of improving the cost base and the mine structure and the optimization. Now, the opportunity is, and this is the magic, is in a yield-starved world where we're in a negative interest rate environment, the opportunity is if certain companies can take a leadership role, not only deliver production growth, not only deliver the margin expansion, but deliver yield. Wouldn't that be not just a home run, but hitting it out of the park? So there's a lot of these themes that are coming together, and I think it's time the industry starts to talk about the opportunity to deliver returns because of the hard work that's been done sort of under the radar collectively over the last few years.
Well, if I may speak on behalf of the investors here, I hope the industry is not going to forget the lessons it's learned in the last 4 years.
Some will. It's human nature.
The last 4 years have been tough. You've had to cut costs. You've had to restructure business, focus on different things. Now, if a price goes to 1,500, you'll figure that other guys are going to forget that. Are the costs going to suddenly start escalating again?
The key question to ask, your companies and their management teams is, how are you going to calculate reserves? What are the assumptions you're going to use at 1,500? Are you going to run it up again? Because that was the fatal flaw in a lot of the strategies where the reserves were being calculated at increasingly higher prices, and all that did is bring marginal tonnage in to mine plants and effectively dilute the grade. So this goes back to the grade question. So what you've got to continue to emphasize as owners of these companies, you know, we're not worried about extending mine life as owners. We're worried about what the next 5 or 10 years look at the business, and we want to generate returns. And so we just come at it from the point of being a company that's paid a dividend for 33 straight years, largely because our founder, who hired me in 1985, really drilled it into us every day that there are owners. And so I think there's a lot of companies over the last 5 or 10 years that have figured out that dividends are still important. And we have to sort of remember that this is underlying just a business. It just happens to be the gold business. And we have to continue to think about it as a business. And I think there's been lots of changes in management. I think there's been a mindset change in boards. But, you know, the owners should take, you know, participate in this and make sure they keep the management team's feet to the fire and remind them as the gold price is going up, look, we want quality. We don't want quantity.
George, silver price has been pretty active in the last couple of days. And what do you think if we start to see silver prices going over $20 again? Just following on from how you structure a business, how you run a business, how do you keep those efficiencies? How do you keep people focused on those sort of issues?
Well, it comes out of the culture you create in your organisation, and I fully endorse what Sean's saying, and I look at MAG as an example. You know, MAG started out in 2003 with 8 people. $1 went to 25 cents, went to 78 cents when Andre invested in the company and bought a number of people from Zurich in, and then we rode it all the way up to a $16+ share price. We saw $40 silver and all that. We still had 8 people. We are still in that same office that we just released for $1 a square foot less for the next 5 years than what we had for the previous 5 years. And some people will make the mistakes. We'll get in there. I think to create the culture, you have to focus your asset. Your asset focus needs to be quality. Once you have quality, you don't need to run your reserves at $1,500. You can run them at $1,100 and even stress test them at $900. And then when the hay comes at $1,700 gold, you mint it. But you maintain the discipline that you don't get fat. And you know, some of us who have been through a cycle know how hard it is to resize a business. You know, good people, through no fault of their own, are losing their jobs. You remember that. And so when you're on that good cycle going up again, you don't get into those bad ways. So it's a cultural thing to me. It has to come from the leadership of the company. Times are good. We're not putting on that extra assistant you need. Does it add value? No, we're not doing it.
Peter, you're nodding there.
Yeah, I share the sentiment here. First of all, let me say that in the reception before this dinner, someone made the observation that sometimes you have to go on intuition and gut feel. This is only an intuition and gut feel, but my intuition and gut feel is telling me that it has been so painful. It's been painful for you as investors, but it has been so painful as executives of mining companies, seeing what we have seen, going through what we went through, that by necessity it has created a discipline in the companies. And so, yes, I think that it is sustainable. Yes, I think that we will be more disciplined, circumspect, introspective before we make decisions. As an example of what we have done and what we are doing, you know, we were counterintuitive up until 2014, perhaps counter-cyclical is the better term, but we were using $950 gold when the average gold price, the 3-year average, was closer to $1,500, and we saw some of those peers going to numbers that were closer to $1,500. We saw that as significant risk. This is a business where we're price takers, and as a price taker, we need to be sensitive to the fact that it is also cyclical. And so what was a $1,900 gold can become a $1,200 gold, and boy, did we see that over the last few years. So our conclusion was we're not going to chase the gold price with our reserves. Interestingly, in 2014, with the almost off-of-the-cliff fall of gold price in 2013, we came to this conclusion. We said, why did we use $950 gold in our reserve estimates? Because gold was at risk. It has now gone through that risk. The high probability is that it does not fall any further. And so we actually said we're now more comfortable using $1,100 or $1,150 gold, but admittedly stress testing it to a lower level. If gold goes, and when gold goes to $1,500 an ounce, my intention would be to insist with our management that we do not change the gold price assumption. Where it is where it should stay. What we will look at, however, because of the local currency inputs, is what is that in local currency? Because I think that makes a difference as well, because we are mining, after all, in that local currency, in that jurisdiction. So I think that discipline is there, certainly for us. I think that discipline is there for the industry, because it has been so painful for you as investors, but for mining companies and executives, that the lesson has been learned. And we're going to carry forward in the next few years. Will it change sometime into the future? Probably. But I think certainly for a foreseeable period of time, this is the best place to be invested today.
Well, that's good. That's good news for investors. And the point on the gold price is actually very interesting in the exchange rates, because the Australians have been getting record high gold prices. Yes. So we tend to focus on the US dollar gold price a lot, but in South African rand or Australian dollars, the gold prices have been at record levels recently. So the Australians are actually making good money. Are there any burning questions from the audience? We have a question here. Can we get a mic here, please? All right, I'll do it.
Yeah, this is just a question about productivity. Is there any measure of productivity other than, I'm thinking about the local currency issue, and can you do it as man hours per ounce or something of that nature that makes it a little clearer as to how, which would be a true productivity measure?
Yeah, that's tough to do because every deposit's different. And I think that's what, as miners, we realize that you can have near surface, easily accessible, large volume deposits, and then you can have deep underground mines that can be narrow, high grade, or thick and low grade. So every mine's different. I think what we try to do is, one of the measures is cost per ton in local currency, because those are the dollars that people are spending. But that has some risk in it, because you've got to make sure that the tons going to the plant are high quality tons and they meet the grade targets. And that's what we constantly watch. I get a production sheet from all of our mines every day. And basically that's one-page detail of the tonnage that's going there, the grade, the recoveries, the ounces produced. And so we can sort of track that to see how we're matching up relative to budget. And that gives us a sense of the productivity. So the only way to truly measure it is, as Peter says, in the local currency. You have to take the exchange rate out of it. And you have to bonus on that basis. You bonus on cash flow and take the gold price out of it based on that productivity.
Anybody else want to add a comment?
I think that's right. I think dollars per tonne is the ultimate measure of your costs. And as Sean said, different deposits, but a very similar deposit in two different operating jurisdictions will have different cost inputs to it. So the challenge for management is to understand where you spend your money. And every mine has a different factor that really drives their costs, or a combination of factors. So if man hours per tonne at a certain operation is a big part of your cost element, you manage that and you control that. But at the end of the day, you chuck it up into dollars per tonne. But a real challenge to running a business well, in any business, but particularly in mining, is actually know where you spend your money. Because I think there are a lot of operations out there that don't really know where they spend their money. Once you know where you spend your money, you then manage those metrics. So it could be man hours per tonne, it could be dollars per kilowatt hour.
I'm not sure I'm going to answer your question directly, but I would like to pick up on a couple of points that were made and maybe supplement some of that. First of all, local currency, local currency, local currency. And let me say to you that we have not always been this smart. For many years, we were looking at our mine plans and we were evaluating those mine plans, and we were comparing to budget based on cost per ton in US dollars, cost per ounce in US dollars. And isn't it great that we're meeting or exceeding budget? Or sometimes, isn't it terrible that we're not meeting or exceeding budget? And what we learned several years ago is that we need to be focusing on local currency, and it is that measure that would give us the best comparison to how we're doing to budget. Let the corporate guys and the world to take care of what happens to currencies, what the mining guys have to do is make sure that they're meeting the budget in local currencies. And I think, as Sean said, cost per ton is an excellent way to look at that. You do have to be careful, as he said. Let me make several other observations. We've just gone through this review and this discussion. I think it is a bit of a slippery slope to try to hedge out your input costs. We've seen mining companies, our peers, that have hedged at $140 oil, wasn't that smart, $80 oil. It's very difficult to predict, and so I think that the prudent course for a mining company, and we get this question a lot from investors, which is shouldn't we be hedging our inputs? Strategically, there will be points where you should do that. We've done that with our Brazilian currency for many years in several programs. But you do have to be careful, because we are mining people, and as mining people, we need to make sure that we're mining effectively. We don't know what's going to happen with some of these other inputs, and we're not in a good position to be predicting. The final point that I would make is we've been very defensive, and it's been the right thing to do for the past few years. And defensive means improving your costs. But perhaps if I can be as candid and as blunt as what I'm about to say, there has never been a statue that has been erected for a cost cutter. No one's ever given a medal to a cost cutter. In the end, it is about efficiency, and I see some people nodding. It is about improvements in production. It is about improvements to grade that leads to improvements in production. And it's about the generation on a per-share basis of an increase in cash flow and ultimately an increase in free cash flow. And that is not determined based on cost alone. There has to be an improvement in production, and you do have to get those ounces. And there is something to be said for high-quality growth.
But I think really what you're talking about, and we seem to be really focused on costs, when the issue is really return on the capital invested. Because if we actually look over the last few years, we've seen billions and billions and billions of dollars of write-offs and impairments on bad acquisitions and bad investments. So our focus, rather than, everybody in every business is constantly looking at improving the efficiency of the business. Where the gold industry has to get way better is in spending the capital and allocating the capital and generating the return. And where companies have got offside in the last few years, in our view, is when there's confusion between the board and senior management and the people executing it on the site every day. Those are the guys you're relying on to make decisions. We're not there all the time. So you need them to make decisions in the context of the strategy. You need to make them compete for capital, and you need to track the return on that capital. And I think that the industry's certainly over the last few years has realized that that is one of the important drivers to attract new investment. We can, hope the gold price goes up, but unless new money comes into the space because they're satisfied with the return on capital that's invested, then we're wasting our time here. And so we need the generalists to come back, and we need the generalists to say, you know what, there's uncertainty in the financial markets. We think that gold's a good place to be to give us some portfolio diversification and safety. And actually, we're comfortable now that mindset has changed, and the companies are well positioned to deliver me the margin expansion that they didn't deliver the last time and get the return on capital. And we can actually break it down to be that simple. And so as we go forward, we've got to send signals, and I think important signals can be dividends. And if we from our perspective, we use that dividend every year in our budgeting process. We put up the first cut of the budget after a life of mine planning process, and we've done it for decades, and we slide the dividend out, and we slide it out in front of all the guys running the business, and we put a bracket around it, what the number is going to be, because that reminds the guys that are making the decisions on the site that there's owners and they need a return. So I would say that the guys running the mines are much more sophisticated than the guys 15 or 20 years ago. They're much more in tune now than they were a few years ago, and those are the guys that we've got to empower to make decisions that are in alignment with the board and the senior management and the overall strategy and direction of the company.
Thanks. I think that answers your question. Are there any other questions? I'm hearing some very good stuff from these guys at the moment. So, Mr. Rosen.
Hi, guys. I'd just like to thank you for having been the co-founders of Osisko Gold Royalties and giving us 28,000 ounces last year. My question comes back to everybody in the room here is charged with allocating capital, whether you're an investor, whether you're a manager. In the last cycle, we saw a lot of allocations of capital on the mining side that have been talked about in quite a bit of detail, but we also talked about on the investor side that investors need to be, I think, a little more prudent in this cycle about who they give money to. And in terms of how we work as an industry, I think there was a lot of value destruction in money that went to projects that probably didn't merit it. It was kind of a rush in. How do you guys think that we can best message to the rest of the investors in the room to prudently manage, if we do see $1,500 gold, that the money goes to the right places this time?
Good question. Yeah, perhaps if I can begin. The comment that was made before is that some of it is philosophical. You have to start with a philosophy, with a mindset, making sure that it communicates all the way down the line and up the chain. Part of what one has to do also, in my view, is because philosophy and mindset will take you so far, compensation takes you further. So I think part of what has to happen is to allocate or to reward people based on key performance indicators that deal with some of these things and to start from the bottom up. And interestingly, that's what we did in 2015, late 2014. We changed our key performance indicators so that we were better aligning what was happening at site to what were the expectations at a corporate level and aligning corporate expectations to what was happening at site. The other part to it, I think, Sean, is that we have to provide more, and the word empowerment was used by Sean, the Sean on the panel. We have to empower, and we have been empowering, local managers. The general manager, the mine manager, the plant manager has to be empowered. We have to treat each of these mines as independent business units. Each project is an independent business unit, and it has to make the case for the capital that is being allocated to it. Finally, I would say to you that the failing, I think, and I will say to you with as much modesty as I can, because we have not been always successful. We have stumbled. Where we've stumbled, we've looked to recover and to regain value from that. 2014 is a year of that, and we've now regained that value. But what I think is the failing is that there isn't enough technical work that is done on projects, and that we're rushing to the development of something based on a feasibility study. The approach that we're now taking, for example, with Cerro Moro, is we completed a feasibility study more than a year ago. We have made a construction decision within about a year of that feasibility study, and we will not be spending money into the ground until we've completed more than 90%, almost 95% of the detailed engineering. So what we're trying to do is we're trying to say button down the project as elegantly as we can, as precisely as we can, because that will then provide more certainty on what the return is expected to be. Once we've done that, then we'll allocate and we'll spend that capital.
Thanks for your question, Sean, because I think there's shared accountability over what's happened here in this last cycle up. The mining companies do get a lot of blame for some of the issues that are out there, but they did get funded. How did they get funded? And I think the key item for me in this is education or awareness. And as the last bull run started to happen, it's when a lot of the old mine builders, mine operators were at the end of their career. They get a little bit of upswing in their options or whatever, they retire and they're gone, and there was a brain drain from the mining sector. And so you had a lot of people with a lot less experience in the past making decisions about project development, construction decisions, moving projects forward, and even running operations and running mining companies. By the same token, though, investors were coming and seeing an investment proposition at $1,700 gold, when the gold price might have been $1,500, and writing the checks. And I agree so much with you, Sean. I mean, the next step for our industry is certainly bringing the generalists back in. Here you get a situation where a lot of the people making the investment decision in these generalist funds aren't as familiar with our industry as a lot of the specialists who invest in our funds. So my advice to you out there is challenge the assumptions that the people in front of you are talking about their assets, their company, and ask the questions of What gold price have you used in your assumptions? What are these numbers at 900? What is the recovery? Why have you assumed that? Is there test work to support that? So more awareness and more diligence on the investment proposition before people make the investment.
Actually, if I may, I've got an observation on one of the problems is, yes, that I think feasibility studies have been done to the best of the ability of people doing them at times, but they just haven't had the skills. They've been stretched. They've been junior people with not enough experience trying to do these things. I've just done a report on where the industry is going over the next 10 years. I presented to Mike Cook on Monday in London. The retirement aspect is going to be one of the critical limits to growth in this industry. The baby boomers are coming through to retirement age. Over the next 10 years, we could be losing 35 to 40% of mining engineers in the mining industry. That's 10,000 mining engineers are expected to leave the industry in the next year. There's going to be nobody mentoring the youngsters. There's just going to be all this experience going to just be wiped off the board. And that is one of the key things that you guys are going to have to handle and manage going forward, I think. I think we've got time for, sorry, I had my 2 penny thought. I think we've got time for one more question. I'm getting the nod from Patrick there. Do we have another question from the audience? Yes, at the back there.
Thank you, Patrick. Just a question. We had a very lively discussion at the late panel today at the show about the management compensation, and as you mentioned, maybe some uneconomic bad projects get funded, the CEO just gets some cash, some options in. So I just want to give that in the round here. How do you think about that? I mean, is there a possibility, or how do you see it, that management should lead by example and detach maybe some part of the compensation to the real part, or can it be actually done? We say, for example, if the rand or the Australian dollar devalues, the stock goes up. That's not really something maybe management does. It just happens and helps on the stock. Or is that a discussion? I mean, it's not only in mining. We have that at Volkswagen these days in Germany as well. But I'm just saying that was really a concern in the audience, and we had also no answer. Of course, the shareholders can vote, but in general, is there any discussion in the industry going on for this, that there's parts of the compensation that can be tied to certain long-term goals?
Yes. Let me weigh in on that. My understanding is that panel discussion, my name was mentioned as well. So I would like to weigh in on that.
Actually, no, that was just general. No names came up.
Yes, the answer is I think as an industry, certainly as a company, I think that we've understood the importance of alignment with shareholders. I think that the compensation is one of the least well understood issues that is plaguing the perception of shareholders by comparison to the perception of managements. I don't think that shareholders fully understand, and indeed I would say that many managers do not understand what is a deferred share unit, a performance share unit, a restricted share unit, what should be cash compensation, and what should the key performance indicators be for that, what should be the performance indicators for longer term compensation in one of these deferred units or performance units. Should a performance unit be entirely based on total shareholder returns, a comparison to peers, a comparison to an index, or based on some form of operational measures? In 2014, we did certain things on the compensation side that were not very well received by our shareholders. And to be perfectly blunt and candid, we read you loud and clear. We got it. And so in 2015, part of that effort that I undertook as the senior most manager, as the chairman of this company, and that our board undertook and our management undertook, was to change those key performance indicators, to better align, and to say to shareholders, this is how we compensate short-term and long-term. These are the key performance indicators that we'll use for short-term and long-term. And on the long-term side, this is what these units mean. This is how they get paid. And if we meet these measures, after lots of consultation with shareholders, then it would be fair to pay because shareholders have made money as well. So to put it in its simplest terms, yes, management of companies, but I think it's not just management at a senior level, it's across the board, should be compensated based on how shareholders have fared. And if shareholders have not done well, then I think that management ought not to do so well either. So it's complex. I have to say that to you, and I think you're aware of that. It's always a challenge. Do you reward management because they met every operational hurdle that they set out, but the shares didn't perform for other reasons? Or do you reward only based on share performance, share price performance, even if they didn't meet the operational hurdles? You are aware, as we are, that there are some companies whose share price goes up, even though operationally they've not done the best that they could, or whose share price goes down, even though operationally they've done all the things that they were required to do. Part of that alignment issue is also short-term to long-term. And this is an industry where it has taken hundreds of millions of years to put the metals into the ground, anything from 10 to 20 years to take it out of the ground, and the investment horizon of many investors is perhaps a year, if we're lucky, and perhaps less than that. I'm going to give a general overview in conclusion. I think that our industry, and I'll pick up on something that Sean said, I think our industry owes it to investors to say, as an industry, this is what it means to be invested in a gold mining company. This is what we can do. This is how we compensate. This is what it means to compensate. This is what production means. This is how we measure it, so that you better understand, and certainly the generalists in particular, better understand what they should expect out of an investment in this industry. It won't be for everyone, but it will be for enough that we'll see share prices go up if we've provided that understanding.
Well, Bjorn, you asked the question, is it talked about much? I think it's probably the hot button issue in our industry. And I think in the world of corporate governance in mining companies, the hottest seat you can sit on is chairman of the compensation committee at the moment. Very complex. Factor in what Paul was saying about the exodus of people from the industry. We need to pay for performance. We need to meet shareholders' expectations. We need to retain people. We need to motivate people. It's not an easy situation. But one thing I can guarantee you, I'm never mentioned in any compensation issues, that's for sure.
Sean, will you wrap this one up for us, please?
Yeah, back in 2011, our board made the decision to start to move away from stock options. So they moved me off stock options entirely and said, you're going to get a fixed amount of restricted share units and performance share units. Not a dollar value, a number. So if the stock goes up, then I do better. If the stock goes down, I go down. And that's about half of my pay. So I think, you can overly complicate these things, and if you follow the proxy services, you're just going to end up with a mishmash, because essentially you've got people out of school ticking boxes, coming up with these wrinkles that just make things overly complex, to the point where some of the suggestions that they're making that we should put into play, we won't even pay attention to them when we run our business. So there's almost some overkill there. So as owners, you've got to just ask for simplicity, make it easy to understand, and drive it as close as you can to the share price performance. On the long term, it should almost be exclusively on the share price performance. The best way to do it is just fix the units, the number of units, and as it go up and down. And you guys know, if the stock goes up, then you're less focused on how much the management's making, because they've created that value for you. If the stock goes down, then the management compensation should go down.
Great. Thank you very much. We're going to stop the conversation there. We'll be eating, and then Martin Murenbill is going to talk. I'll introduce him a bit later. Thank you for your questions. Hopefully, I think there's been some very candid answers here. Hopefully, you've heard some good things from at least these three leaders in industry. And if let's see if they, when they come back next year, you can hold them to task and see if they've actually delivered on what they've said this year. Will, can I ask you to thank our panel members, Sean Boyd, George Paspalas, and Peter Marrone. Thank you very much, guys.